I hear it all the time. I just met with my financial advisor. We just set up my policy. I'm so excited. And then when I get behind the curtain and I see the policy, it's normally an IUL, a VUL, or a policy not designed for the infinite banking concept. So on today's episode of Solving the Money Problem, we got Brian Fouts here to talk about his journey into the infinite banking concept and how it started just like that in 2016. Let's dive in. So Brian, tell me a little bit about your journey. How did you first get into the infinite banking concept? Wasn't it around 2012 or something like that?
Yeah, my daughter had been born about a year and a half before that. And I said, hey, I probably should get some life insurance since I'm the main breadwinner in the household. So I went to my financial advisor and said, hey, I probably should get some insurance. And he's like, yep. And I know this thing called cash value life insurance. And that's when I first heard about it. But I'll be honest, I didn't know what it was and he didn't either.
What do you mean he didn't either? Tell me about that.
So he
I mean,
just
he's a
mentioned,
financial advisor. I mean, he should have known what he was doing, right?
you'd think so, yes. But he said, hey, you'll build cash value. It's safe. It'll create a legacy for your family. You can borrow against it and go invest and do other things over here. All these things that sounded great. And I
Yeah,
was
I
like,
mean,
sure.
what was it?
It was, well, I didn't even know what it was. This is the problem. He did not even know enough about what he was talking about to teach me what I should be doing
Wow.
with it. So I kid you not, fast forward many years later, 2016, something very catastrophic happened in my life. That financial advisor was no longer part of my life, by the way. But I was very fortunate to get a mentor that knew infinite banking very well. And that's when I first realized, oh my gosh, that's what that advisor was talking about. And that is not what he sold me. That's not what I had. I found out it was a variable universal life or VUL policy, and it was not designed for infinite banking at all.
Well, a VUL would never work for the infinite banking concept. And just
No.
just so the audience knows, a VUL or variable universal life is a universal life policy, kind of much like what you would hear of today with an IUL, that has a separate account of mutual funds. You can pick and choose your mutual funds, invest those dollars in this separate account while still getting the growth and all the advantages of life insurance. However, 2008 was the catalyst for VULs because in 2008, most VULs failed, mine included. The only reason I still was able to keep my VULs because the company it was with actually allowed us to keep our policies, even though they ran a negative balance, to cost of insurance. So like yours sounds like a very similar situation where you were put into something that just wasn't built for the long haul.
Yeah, I lost hundreds of thousands of dollars of potential wealth because my money was just going into this thing and it was not creating any value, cash value. In fact, I don't remember how many years it was. It was like 5, 7 years before there was even $1 that I could borrow out of this thing. $1.
Wow. Well, I mean,
And
that's pretty common of universal life. They have surrender charges, and your policy was probably built right at target, which means that
yep,
it's anemic. I mean, barely
yeah,
has any cash value growth, but the commission was probably pretty good.
probably was, and then good for him. But yeah, and if you looked at the illustration, the numbers, the forecast, it'll go to zero before I'm 85 or 80 years old. It'll go to zero. I'll lose everything, cash value, death benefit. It literally projected it on the thing. And I was looking at that thing after I learned about it, realizing this is going to implode itself because of rising cost of insurance. It was not designed for what he had said. Yeah. So
But when you bought it, didn't he show you an illustration that showed that it wasn't going to make it? I
he
mean,
didn't
or
show me an illustration.
he
He didn't.
didn't?
No, there was no illustration given to me when he sold it to me.
Wow, Brian. So you were just, the advisor was just like, hey, give me X amount of dollars and I'm going to put it into this thing. And this thing is going to do this other thing. And this is going to be great.
Yeah, exactly. Pretty much. I mean, of course, he did sell the death benefit as well. Hey, you're going to get this death benefit because that's initially what I thought I needed was the death benefit, which is a need. But I could have got a term policy that was cheaper and more death benefit and it would have performed almost the same because this thing, it was not very efficient. But yeah, that was my first, launch into infinite banking. And then that financial advisor, come to find out, he did not use it himself. So he was selling something he was not even using. That was one of the biggest red flags. And for anybody listening, huge red flag. If someone's selling you a Honda Accord and they drive a Ferrari, that makes no sense. It's like you're going to go to a Ford dealership to buy a Ford. So I got sold something that person was not even using it in their own life.
So what happened? I mean, did the policy lapse? Did you just let it go? I mean, this new mentor that you met, what happened after that point when you realized you had been sold a bag of crap if you will, with this variable universal life?
Well, so my mentor was mainly just teaching me about the infinite banking concept. And so I ended up going and doing my own research as well. Because this person, they weren't like sitting down with me and spending hours and hours with me just teaching me that one concept. But I was learning from them. But I went and did my own research and learned about it, talked to a lot of people about it, and ended up keeping that policy because I was like, well, I've already put someone into it. It's going to grow. It'll get cash value eventually. I'll make it, for another 10 years, let's just say, and then get rid of it then because it'll have mathematically got to a point where I'm not going to lose as much. So, and also I did need a death benefit, but then I went and got another policy. So I did get a smaller policy to really start using it as infinite banking, start experimenting with how it works. Because once again, yeah, I did have someone that taught me about it, but I would say this. They were talking about the features of the car, but they weren't teaching me how to drive the car. So what I learned was if you want to make infinite banking a real, win for you in your life, you've got to understand how the car drives. You've got to be able to get in the driver's seat. And that's what I always found was missing everywhere that I went. Nobody was teaching me how to drive the thing. Oh, yeah, they could sell me the car, but that was about it. And so
That's
that's
a
what I
good
did on my own.
analogy. It's a
Yeah.
really good analogy.
Well, when I'm speaking to infinite banking, and I don't remember where I learned this, but it was years ago. I always say infinite banking is a car. It's got wheels and tires and seats and all that kind of stuff. But what's it need to go down the road? It's got to have a good engine. I was sold a very bad engine, so it did not perform. But I went and did my own research, realized you got to have a good engine. All right. That, as we know, is a dividend paying whole life policy designed for infinite banking, that car. But then I had to go learn how to drive it. Nobody was talking about this. Nobody said, here's how to drive this and how to use it, how to be the bank in your own life. And so I went and did that, but then I started talking about it. So through a business that I had acquired, actually that financial advisor, they lost over $500,000 of my money
Wow.
in one big fell swoop. It happened in about a week. At the exact same time, I took on over seven figures of debt.
So wait. How did the advisor lose $500,000 in a week?
So this was 2016. He had a large investment fund, over $20 million he'd raised, and he declared bankruptcy.
Oh my goodness.
The
So
SEC,
so this was that financial advisor?
yes,
He had his own fund?
yes.
Oh wow. Surprised he's not in jail. Or is he?
He was almost there, almost there. He got out of that by the skin of his teeth. The SEC got involved.
Of
So
course they
that
did.
very high level. So big bankruptcy, lost. I mean, all this money was gone. I lost my money, lost, and I'll just be honest, some of my parents' money as well. And it was horrible. And that all happened. And then I took on seven figures of debt from a business that I was acquiring. But my income at that point was, as an entrepreneur, was from the investments that I had from this advisor, real estate and oil and gas and other things performing very well. But once the bankruptcy hit, I lost all ownership rights to the assets. And the courts and the SEC took them all. And I lost all. So I lost all my cash flow and the money too. So I had 45 days at this point in time to basically make $100,000 to keep my business and my house and my family together. And I had $5,000 to my name. And I just learned about infinite banking at that point too. And so while I knew infinite banking was like the thing I wanted to get into, I couldn't jump into it just yet. But that business taught infinite banking as one of the things that it did. It taught the concept. And so I was able to go and use my network, by the way. So your network, they are combined. In my opinion, I went and I made $145,000 in 25 days through that business and revenue and kept that business and kept everything. And then that's when I really dove into the infinite banking, started learning how it functions.
So
Yeah.
how did you do that? Was it like marketing? Like, I mean, how did you just turn it on that fast to make
The
that much
business?
money in a short period of time?
So the business had some assets that were not being utilized, and I utilized them. One, if you're in the marketing space, you understand how valuable an active email list is.
Yes.
So I had an email list of about 100,000 active people. And so I was able to monetize that through different not mentors, but I guess I would say they're trainers, Robert Kiyosaki's advisors. So I brought them in. We were teaching strategies and concepts, and that content helped a lot of people. And that's what that business did for revenue. They sold I guess info, educational info. Yeah.
Huh, interesting.
Yeah.
So, see, you saved your business, you saved your family, and didn't have to move out of your house. So then what?
So then I just started saying, no, how do I learn about marketing? Because I had a marketing-based business, and I didn't really know anything about it. That advisor that lost all my money was going to be like the main figurehead of that business. But obviously, when a bankruptcy like that comes down the pipe, he was out of the picture. His name was not on anything. So I just kind of took it over, along with my brother, by the way, he helped out. But I started learning about how money worked. And I was like, it was literally boots on the ground. Like I was flying to people's offices. I went to Utah. Went all these places, met with the advisors, and just said, hey, teach me about money. But we were filming the content. As I was asking these questions, we were filming it with cameras and everything. And we were creating courses on different ways of investing or how money works or whatever. I even built an infinite banking course, but it was me learning about it while doing it. So that
Yeah.
was one thing I love to do. I love to learn, but I love to share what I'm learning. So I said, why don't I just combine these two things? I'm going to go learn from all these people. I'm going to bring people along for that journey. And that's what I did.
Well, that's
We
what
had,
that financial advisor back in the beginning should have done. Should have done it themselves,
oh, yes.
learned about it, then passed that knowledge on to their clients. But that wasn't the case. But that's what you were doing. You were
Right.
learning, applying, and then teaching. And I think
Right.
that's a good model.
Yeah.
I think a lot of successful coaches and a lot of successful people, that's how they do it. They speak from actual experience. Like, I know, like, and understand this because I did this, or because I failed at this, and this is why I failed and why I never will again. I
Yeah.
love that.
So it was a journey. I'll just be honest, and I still at that point in time was not using infinite banking like I should have been. But once again, I was learning. I was not being taught by someone who had gone through all this stuff and said, "Hey, this is exactly what you want to do to get to your goal." That's the one thing that I learned was if you're talking to somebody about something like this, the question you want to understand first, if you're going to help them understand their goals, understand what they're trying to accomplish and get out of this. Otherwise, I'm going to give you a Honda when you really needed a semi truck, as an example from the car analogy. Like I got sold something that was not what I needed. So that was a big thing for me, learning about, okay, how do I talk to someone or educate someone based upon their outcome so they can see it? Because I was not given that opportunity to, say, this is what I want to accomplish. Oh, by the way, here's the best way to get there. It just didn't happen that way.
Like, how did you eventually do that?
Trial and error, a lot of trial and error. One example is as an entrepreneur, I was spending 100 to 150,000 a month on Facebook on ads. In hindsight, I should have been spending more, at least equal to that, or half of that, I mean, on YouTube.
Mhm.
But that was a big thing. But once again, you're talking 2016, 17, 18, 19. YouTube was still growing, I guess I would say back then. I didn't know about how it worked. So a lot of lessons learned, but I should have been taking as an entrepreneur money off the table. If you're doing, 200,000 of revenue a month, which is what I was doing, I wasn't taking any of that off the table through a policy because I was never taught that. And I hadn't heard about that concept. Hey, if you got a business, run it through that, recapture it, and then put it back to work again. I literally have done the math, and I will only do it probably one time. Over seven figures I could have had through policies of cash value wealth.
But
When I look
unfortunately,
back,
but you just kept plowing it back in. I mean, where did the money go? Because I mean, you're making 200,000. What were you doing? Were you just blowing it?
so at this point in time, even though I was doing that, I was not a good business owner. I'm very honest about that. I was not a good business owner. Nobody taught me. I was just figuring it out. You do not want to figure it out while spending 150 grand a month on ads. You do
No.
not want to figure it out. That's painful because one little thing can disrupt the entire, ship, which is exactly what happened, by the way. So as I was learning about this stuff, COVID hit. My business was on the Inc. 5000 list, and the first year of COVID, it was on that list. But as we know, the things like when COVID hits, it takes some time for that to, I guess, trickle down into the economy. You see the results not immediately, but after the fact. Just like inflation, it causes rising prices, but it takes about 3 years to see it. My business eventually tanked. So I was plowing money back into it, but where was it going? It was going towards, I was trying to buy the answers. I was trying to bring in mentors, advisors, experts, coaches. I was trying to find out, okay, how do I get this business to a certain point where it's sustainable in the long term? And I was making a lot of people a lot of money, not me. That was one of the other big, big lessons learned. I don't say mistake for a reason. I say a lesson learned because these people were getting very wealthy off of me, but it was not helping me or my business.
What about your clients? How were they doing? The ones that were buying these courses, were they self-fulfilling courses, or was there a fulfillment aspect that you had to
Oh, no.
deliver on? Like, what was that course like?
They were doing very well because a lot of them were saying, "Hey, I've got money, or I want to learn about how money works." And so they were just learning because knowledge is valuable, right? But
Mhm.
obviously, you got to apply the knowledge for it to be invaluable, as I kind of say it, right? So they were able to work with the people that were teaching. So all the advisors that were creating the content, they could go work with them one on one. So I was having clients that, hey, they say, I want to go talk to so-and-so, or I have this challenge. I would then connect them with the network. So they were actually connecting with my network, and it was awesome. People were having success. They were happy. They were doing, by the way, they were doing infinite banking. But once again, I was only educating. I was not implementing it.
Hmm.
That's something
Backwards.
if I had been on the implementation side, oh, you want to hear another number? Commission. So even though infinite banking pays a very low commission, I was not really getting that. But the advisors that were fulfilling for my clients were getting it. And the amount I realized that I left on the table from what I could have done, hundreds upon hundreds upon hundreds of thousands of dollars.
Wow.
The amount of, and this is, just if you're in the insurance space, you might know this, but the amount of premiums that were captured was staggering. I mean, you're talking lots of seven figures. And so once again, lesson learned. Geez, if you have people fulfilling for you and your clients, you better understand the full journey because they did. Those advisors did. I did not. So,
I,
but once again, I'm happy my clients got the value though. That's at the end of the day, that's it.
Yeah, and that is a good thing, but I'm still struggling a little bit with, you go back to your original story, that advisor that sold you that VUL who wasn't using it himself and how you felt about that. But now here you are, you're teaching the concept, the infinite banking concept. You've got clients who are getting into it, using it, but you're still not using it. When do you learn the lesson that you have to actually do to teach or do to actually be successful in showing others?
So I would say I learned all that probably 2020, maybe before that. I learned about it, but I still, there was a gap. I was missing the implementation side of it. Like, so I had a policy, I got policies and stuff, and I was putting money into them. But once again, I should have been putting about five times what I was because I just couldn't see that missing piece. The missing piece was rolling it through it and then putting it back to work over here. I couldn't see that picture yet because once again, my education and all my stuff was more on the beginning, not the end of it. So it was putting the policy in place, how it works, how the policy functions, all that, but it wasn't on the being the bank side of it. That was what was missing, was being the bank. I had used my policy for things like Christmas or a vacation or things like that, because that's what my mentor had used as examples. But it wasn't still being the bank. I was just saying, instead of using a credit card and paying interest through a credit card company, I'll pay it back to myself. That is infinite banking, by the way, but it wasn't wealth building. It wasn't changing my life. So
Good point.
fast forward 2020, the business started to go the other direction. The ads were not performing. Everything was getting very expensive. I was like, this business is not going well. And I realized I think it's going to have to shut this down. I'm going to have to shut this business down, it kind of broke my heart because I had poured 8 years of my life into this business, 7 years of my life, just poured it, poured it, poured it, and watching it not work. So I had to take a step back and say, you know what, it broke my heart, but also my heart wasn't in it. But so I had to kind of go back and go back to my Bob Proctor teachings and said, 'cause I went through his course and I love that guy. And I had one of his right-hand guy was one of my mentors for this. And it really helped me understand a few things. But one was this is like, what do you want to do with your life and your time that you enjoy doing, that you'll pour your heart into it, you pour your time into it and not care that you poured your time into it. You're happy that you did it. And I had to sit back and think about that and it was not like days, it was months. And I realized internet banking is the one thing in my life that has been constant, has been consistent, and that I can talk about with passion and not even have to try. I'm like, okay,
Interesting.
yeah, I love it. I love this whole thing. And I dove it even further in. And this time I said, I want to make this my focus, the thing that I do with my time in life. And that's what I did. And so I started talking more about it. I was already doing webinars and stuff. And I knew this gentleman, his name was, oh gosh, Chris Naugle. Yeah. So I knew this gentleman named Chris Naugle, and I started watching more of what you were doing, and I realized it felt in alignment, but also it was a kind of a missing piece for me. Like the implementation side, teaching them to drive the infinite banking car. That was what was missing. I picked that up in about a day. Not honestly a day, but I picked it up very quick. I realized, dude, I could do this. I've been doing this for so long. And I want to do that. And that's how I really got into helping people use this as well. Um, but yeah, and that it just took some time on my side to I guess, kind of make space in my life to do infinite banking fully. And it wasn't there before because I was so just distracted and focused everywhere else. But I had to really sit back and say, I want to do this. But it required one thing first, and that was to do it for me. I had to do it in my own life before I was teaching other people. So that's one thing I did is that I'm going to do it in my own life, which is what I did. And then I went and started teaching how to implement it with other people. I could talk about it, but then it was like, let me help you use it. And it was that was obviously a few years ago, and the rest is history, so to speak.
I love it. Yeah, and now you are actually applying the infinite banking concept, contrary to that whole backstory. And now you're teaching others. In let's switch gears. Let's talk about some of the people that you help. And I know you have some
Yeah.
visuals to kind of show that because look, this is solving the money problem, which we're talking about your money problems, which were pretty severe. And now you're starting to solve your money problems through this journey, and now you help other people do that. So let's
Yeah.
talk about some of the folks and how you've helped them.
Yeah, I'll share my screen here. I got some things that I put together. These are just some case studies that of clients that I've worked with over the years. I went back and said, okay, what have they done? What do they do? And I was very, very surprised in a happy, good way of what they had done with infinite banking. So yeah, so Chris, over the years, I've helped, hundreds, if not thousands of people do infinite banking. So I went back and said, hey, who are some clients that I still know who they are and they've had success, they've used it, and let's see what they've done. So here on the screen, so this was Mike. So Mike was a business owner and he wanted to buy equipment for his business, but he didn't want to keep using banks to do it because they had all these terms and he'd go buy the equipment, then have to make the payments, but the equipment wasn't generating any revenue yet. He did not have control and he did not like that. And so it was a mid-sized construction company in the Midwest doing about 1.2 million of revenue. So it was a fairly sizable business in that space. But yeah, he just did not want to use existing banks. He wanted to have more cash flow. And also he wanted to have, I guess, flatten out his cash flow a little bit too, so that when he had accounts receivable and things like that, he wasn't draining his cash. He could use a line of credit, but infinite banking was a fit. So he had to go buy a new excavator and a service truck, $120,000. Bank said, hey, we can do that. 8%, 5 years. A lot of documentation, a lot of documentation. He'd have to provide a bunch of collateral. Obviously, the equipment was part of it. They wanted to lean some of his other business assets as well. And he just was like, I don't want to do
Wow. So they wanted cross collateralization above and beyond the excavator and the truck?
Yep. 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 Yeah, it was, and it was they considered it a high risk loan, I guess, for some reason. I don't remember why they considered it, but he wanted access to funds, faster control, all that kind of stuff. And he wanted to start doing something outside of the business that could support his family down the road because he wasn't doing that. And so he didn't have like a 401k. So what we did, and this was time though, keep in mind, when we were talking with Mike, he was like, hey, this is not going to be day one thing. I want to do this, 3, 5 years down the road and then just keep doing it every 5 years. So he said, let's set the thing up 3 years ahead of time because he didn't have to buy the equipment right away. He could wait a bit. So we did a special design policy. I had one of our advisors in my business set this thing up. He was doing 50,000 per year annual premium, around 35 to 40 going to the cash value, so rapid cash value growth. And by year three, he had over 135,000 of cash value inside that policy, and he was able to go and take action, get the equipment with his policy. He was his own bank. He did not have to worry about the bank taking, the collateral, none of that stuff. He was fully in control, and then he could structure the payments back to himself. So he looked at his cash flow, said, how much can I pay back? Treated it like a lease to own, paying 2,300 back to his policy. Cash value was growing, and yeah, he was very happy.
Wow.
Um, but yeah, and then also the taxes. So he also was like worrying about taxes because in construction, taxes are a big deal. I used to be in the industry for 14 years, but the policy loans aren't taxable. He was able to write off the equipment purchases and some of the other things as an expense. And actually, when we did the math on it, how he was doing this, he was making more money than just working the equipment in his business, but also by the taxes, he was saving money as well. So he was making money more than once, and infinite banking was at the core of how he did that.
Yeah, if you find a good CPA, the CPA can kind of help navigate things like that and work with us and work with you as well. I'm sure you worked with this CPA to figure out the tax side of that. But, I think there's a lot of stuff that we don't talk about just because we can't give tax advice that is even more advantageous. And you kind of just mentioned it in this use case.
Yeah. And having a CPA that understands infinite banking is also key because I'll be honest, it's hard to find them. They're not, most of them don't understand it.
That's
But
for
yeah,
sure.
that was how Mike did it with his business. So this is another one that I really like. This was Sarah and Jason. And this is something that I have personal experience with because I have 3 kids. But they wanted to save up for college and they were looking at different strategies. They had, 2 kids, 17 and 15, Emily and Luke. Uh, and they were saying, hey, how can we do something that can pay for college, but also benefit the kids down the road? Obviously, they learned about infinite banking, and they learned about this actually from our BYOB team here. They learned about this whole thing, but they had a $180,000 dual income, and they wanted to avoid student debt. So that was the big thing because I found this out. Sarah and Jason had student debt, and they realized that she was a teacher, and she said, "My teaching job is not even adequate to pay my loans. It makes no sense. Why did I even go to school? It's just ridiculous." So they didn't want the same thing for their kids. They wanted to do a different path. They were looking at different ways of educating their kids, maybe not going to college, maybe doing like a trade career. But then they're like, well, then what would you do if you had like a what is it, a 501
The
fund?
529 plan?
Yeah, 529. They were looking at doing those, but then they realized if our kids don't go to college, then it kind of makes no sense. And obviously college is going up, all that kind of stuff. So they didn't like the options available. They didn't like that they would have no control over how the funds are used. Tax penalties, of course, with the 529. The funds are exposed to the markets. They can go down in value. They wanted to really have their money be safe, be able to use it for whatever the kids wanted to, but without saddling them with debt that if they didn't make a payment, then it's going to come back on them. So as same with Mike and the construction company, we looked at a plan. How long is this going to take? How many years do we want to do this for? So ended up getting a policy on Jason first because he was the main primary income earner in the household. Did a 30,000 per year premium, 22,000 going to the paid up addition so they could build that cash value inside the policy. And then after 5 years, they're going to build up about 115,000 of cash value inside this thing, and they can go use that for college. So this was about 3 years ago when we did this, I believe, for them. Fast forward later, Emily is going to go to State University, we found out. So out of pocket 1 year, $28,000. So instead of doing student loans, Emily is going to get a part-time job. So to pay for just some of her fun money, I guess you call it. And then they took a policy loan for tuition and dorm at 5%. And then they're going to structure payment back where I think that Jason and Sarah are going to make the payments back. And then once Emily graduates, then she's going to take over once she has the cash flow and teach her how it works. So that's what they're doing right there. Same thing for Luke, their son. In 2 years, if he goes to college, they have enough inside the policy to pay for him. But they're going to keep using this same policy for the kids for college. If he wants to go to trade school, they do it for that. Doesn't really matter. But yeah, and the results for them is they avoided taking out those parent plus loans. I didn't even know what those were when I first heard this. It's called a plus loan. They were going to tap into their home equity for a while. They are not going to do that now, which made them relieved, but maintain control over the money. And they're growing the whole thing. They're eventually going to be able to use these things for investing. They're getting policies on their kids. I think they already got them. I can't remember, but they're getting policies on their kids and everything. So yeah, it's a great way to do it and gives you a lot of options and flexibility.
And I like that you mentioned on there that it kind of bypasses the FAFSA requirements. And, a lot of people maybe do or do not understand that, but the life insurance is an excluded asset from FAFSA reporting. So if you had $1 million in cash value inside of a life insurance policy, like what we're talking about, you wouldn't have to put that on the FAFSA application unless that's changed up to this point. That was always a really, really powerful pro to getting life insurance and putting cash value life insurance into place for what you just mentioned for a kid's college planning.
Yeah, yeah. But the key thing when you look at some of these examples here is what we're doing, Chris, here is we're looking at what they're trying to solve and we're designing it for that. It's not they're saying, hey, here's a policy, good luck. We had to sit down and go through this and have conversations, have meaningful conversations to find out why are we doing it this way? What are the options, pros and cons and all that, so that when this thing is there, they know how to use it, they know how to put it to work, and it helps them accomplish their goals. And I think that's a big thing that's missing oftentimes in a lot of financial industries, but also in this one too.
Yeah, and
Uh,
also, I think you mentioned it earlier, but with the 529 plan, you put the money in, there's restrictive things, but if you use it for college, but once college is done and paid for, that's it, it's gone. That money never works for you again. So, yes, you got the education, but your money is all out there. It's gone. It's a huge lost opportunity cost. Where within the policy, if done properly, as you mentioned, that money that was in the policy continues to earn for them, continues to make for them uninterrupted. So that money never stops earning compounding interest for the rest of that kid's life or the parent's life, for as long as the parents own it. So I think that's another really important facet to what you're talking about here. And also the fact that they're in control of what they do with the money. I mean, the kids, maybe they don't go to school. Maybe they go into trades or maybe they create their own business or Maybe they become a professional athlete. You never can tell, but none of those, unforeseen things that could happen, like, not wanting to go to school, are going to disrupt this planning. This planning would continue and be able to be used for anything else. So I think that's a really powerful piece.
Yeah. And also, I mean, this is the first one. Obviously over time they've gotten more policies and created more of a family banking system. So yeah, very cool how they did it.
Well, yeah, teaching their kids how to be their own bank. I mean, you talk about a legacy that will carry on for generations and generations. Instead of giving our kids the things we never have, like Bruce Lee said, you teach them the things we never learned. So in this case, they're real time teaching them how to be their own banker, how to keep control of their money, and how to use that money perpetually over and over and over again to finance all the things in their lives.
And why I said I like this example is because my daughter, she's going to be turning 16 here soon. She doesn't want to go to college. I'm not pushing her to go to college either. I went and I'm like, you don't need to go to college. What do you want to do? And so she is probably going to go into the trades. And she has a big passion for, and this is a weird one, at being 15 years old, she wants to be a tattoo artist. She loves to draw and design and that kind of stuff. And so policy has some money inside of it. And if she wants to go do that, she can go use that policy that we have for the equipment, for renting a space, for getting a mentor and learning. So it's exactly why I went and got a policy instead of something like a 529 so that we can do it for whatever she wants. And come to find out, it's exactly what's going to happen.
That's interesting.
Yeah.
Yeah, I mean, that's a perfect real life scenario there. I mean, that decision to not go to school and become a tattoo artist, it definitely doesn't fit the traditional narrative. And certainly, if you had set up 529 plans for her, you'd be pretty well screwed. And so would she, because now that money would have to either be used for Brian to go back to school. And I don't know, do you want to go back to college, Brian?
No.
Okay, or have more kids, or you got to pay the piper, you got to pay the penalties and the taxes on the money if it's not used for the proper use case.
Yeah. And like my son, he's 13. He's not going to go to college. He's autistic, so it really is not even going to be an option for him to go to college. So I could not even apply that policy if I'd done one for my daughter. I could not apply it to my son.
Hmm,
He's not going to go to
interesting.
college, you
Yeah, I
know?
love that.
Yeah. So I'm so glad I got these instead. It really kind of a breath of fresh air a little bit because I was stuck in that whole I had the 401ks, I had the IRAs, I had all that for years, and I just always felt stuck with that stuff. So here's another one that I really wanted to share. This is Chris and Jennifer, and this is something that we see a lot when it comes to infinite banking, or even before infinite banking, we see this a lot. People are drowning in consumer debt. And Chris and Jennifer, same thing. They had 110,000 of combined income. She was a teacher, he's a firefighter, and they had debt. So they had two car loans, 32,000 at 6.5%. They had credit cards going out the door, and they were drowning. And I could relate because I felt that same way multiple times in my own life, but they didn't know what else to do. And they kept just repeating that same debt cycle. They'd get rid of one car, pay it off, and guess what they would do? Go get another car. They trade it in because that's what they were taught to do. They were taught to keep their money in other people's control. Banks, credit card companies, Wall Street, corporate America, whatever you want. But they didn't feel in control. And so when I was talking to them many years ago, they just said, Brian, we're sick of this. We're sick. We're tired. We want to have more control of our money. We feel like we're making a lot of high monthly payments with little principal reduction, right? They're just like, where's the money going when we make these payments? They couldn't build up any savings because all their cash flow was tied up in debt. And their jobs, he liked being a firefighter, but he looked at that job as just something to do to stay afloat. He wasn't getting any joy out of it. Same with her. She's a teacher, but she'd have to always work overtime for like Christmas or stuff like that, or to make ends meet. And they were just frustrated without any savings. And they felt like the banks were just taking advantage of them, which, Chris, you and I know that's pretty much what they are doing. So they said, hey, can infinite banking help us? How can this help us accomplish our goals of being more in control of our money, start building wealth instead of losing it every single year? How can this work? So they did a policy. They said, hey, we can do a 24,000 year premium, which is 2,000 per month. It's going to be a massive, massive stretch. But they said, hey, if we can, we're pretty used to doing that kind of stuff. But if we can do that in a short period of time and start getting control of our debt, all of a sudden it can change things. So we mapped this whole thing out. And by the way, they were really redirecting money. So that's a big thing that I think a lot of people have to understand is that, hey, I can't put $1,000 into this. You got to change your thinking. Where's my money currently going? And can I take some of that cash flow going over here and redirect it to a better vehicle? Infinite banking. So that's exactly what they did. So they were really overfunding their retirement, but they were drowning in debt. I was like, hey, this is not financial advice, but an option could be to reduce your retirement funding temporarily, by the way, so that your money can go to work getting rid of the bad debt. And once that's all taken care of, and now you have more money in your life, go back and start putting it back into the retirement fund again if you want. That's an option. So that's exactly what they did.
Well, I think
Um,
that's really important because, like, here they're overfunding the retirements for some future goal of retiring, right? After 59 and a half. Most people don't retire till their 60s. So this couple, they're buried in debt. They got car loans out there at 6.5%. They got credit cards between 18 and I believe you showed 24%. I mean, what if they were to be able to get, 15 to 24% return on their 401k? They'd be thrilled, but that's not realistic. But here they're giving away 18 to 24% on these credit cards. So it's literally like you just said, it's looking at it differently. This isn't new dollars. They're not going out there and working harder, longer, or taking on more risk to be able to fund this system. What they're doing is redirecting dollars they were already saving for a use that's going to give them a much better outcome. I mean, gosh, there's a lot of people like this family, a lot of
oh,
people that are
sure.
buried in debt, struggling, and yet plowing money in for their future, which is retirement. And I get that, but like retirement's not going to look very good. You're not going to live a very good life in retirement if you're still buried in debt. If you go through your whole life in debt and then you retire, like nothing changes. You're still stressed. You're still dealing with paycheck to paycheck type scenarios. So this was a really good move on their behalf.
Because one of the other conversations I had with them was, do you want to work 40 years and be miserable to then have 15 years of retirement where you're maybe happy? It was kind of a weird thing. I'm like, so that's part of what they did. But the other big thing that I want to mention that they did too is we were going through their numbers, I was like, wait a second, what's this thing they had something written on their form in May. Like, oh, that's our tax refund. And it wasn't like $12,000, but it was more than six. I was like, wait a second, you're giving the government your money for free, but you're drowning in debt? That makes no sense to me. So they went and changed their withholdings on their paychecks. So all of a sudden their income went up by 600 to 700 per month.
Wow.
And so I was like telling them, is that going to help you? And they're like, yes. I'm like, okay, but that had nothing to do with even infinite banking. It was just, hey, why give the government free money? Because all they would do is take that refund check, whatever it was, $6,000, $7,000, and they would just put it into a credit card. They just
Yeah,
pay down
most
some
people
debt.
just blow their tax refund. They go out and they spend it on frivolous things, because it's like they feel like it's free money that just appeared in their mailbox, but it's not free money. It's money that you gave
Yeah.
to the government used for 12 months or longer, and then all of a sudden realized that you had overpaid your taxes, so they're refunding that. And people think that this is a windfall of money. This isn't a windfall. This is poor financial decisions. That's what that would be.
It's a free loan to the government. I mean, really, it's kind of what it is. And so with this family, when I said, $2,000 is a big stretch for them. Well, in reality, when we did the math before we even did any kind of policy, they were going to be funding the policy with it was like a couple $100 out of pocket. That's how they viewed it. But in reality, the money was there. It was just not being utilized very well. So we just reallocated where their money was going. Remember, what's number one? Pay yourself first. They were not doing that. They were paying everybody else. So instead, now they're paying themselves first
Mhm.
before they do anything else. So fast forward, they were able to repurpose $1,150 of debt payments. So they recaptured that. They put that back into their policy. And then they said, hey, we can put in $200 more per month to accelerate that payoff. So they were like all of a sudden in more control of their money in their life. And it happened very fast. They were shocked that it happened that quick because they're like saying this is happening very quick. They were thinking they're going to have to pay these debts for 15 years, but it happened very quick. So they had a loan repayment schedule for 3 years, taking about trying to remember how many years it was. It was about paying their debts off 3 years faster. So it cut the time in half. But they were using the same dollars that they were already sending to the bank. They just put it back into their control first, their own family banking. And as I said before, they maintained that flexibility. So they did have tight months because of her job and his job. He could work overtime and sometimes wouldn't. At summers and all that kind of stuff, cash flow would change. So they could adjust their payments on their policy for their cash flow. So they were suddenly like, okay, we're not stressed out, we're in control, and this is awesome.
Yeah, and the other thing too that's always cool about that is when you are the bank, you mentioned that loan payoff, you're paying yourself back. So like think about it. If you own the bank and you're making payments back to your bank on a loan that you took from your bank, who's getting control of all that money? Who gets the liquidity of that repayment? You get all of it. Like
Yep.
every dollar they're putting back into the policy as a loan repayment is dollars that they have the next day to use instead of giving it away before making debt payments trying to pay their credit cards off where they don't get to use that money again. That money's gone forever. Here they maintain control of all that money.
Stays in their hands, stays in their family banking system. Yeah, and did the math on this. Obviously, we have the software that does that. That's how we were able to do this and look at it. But yeah, $12,000 of interest payments was recaptured, paid the debts off 3 years faster. I think that was almost cut in half. But very important though is that they have $40,000 in the policy after they're debt free. So instead of like, okay, we're debt free and have zero savings because we put all our savings into paying off debt, they actually have the debt gone and the money still in their control. It was a huge mindset shift for them because they did not think that was possible. Now their plan is to use the policy as a down payment on a small rental property because they had done some stuff in real estate years ago and wanted to get back into it. So the first thing, get rid of the bad debt that steals and destroys money and wealth. Second thing is now put that money back to work and start creating more cash and more assets in their lives. And so to say that they've completely changed the way they think about money is really an understatement for this family. Their whole future has just changed because they did one thing, pay themselves first,
That's
and
awesome.
then more things after that. And kind of visually to look at some of the stuff that that they've done, but you can see it here. Like this is the difference. Traditional on the left-hand side, you can see how much principal and interest they're going to pay. On the right-hand side, it's different. You can see the difference right there. So I wanted to do a visual on that one because we went and started doing the math on this, and they were shocked. They were saying, "Oh my gosh, this is insane! How much we're saving?"
Yeah, that's a
It's
huge difference. And the cool part here is all they did is changed one thing and added one step, which was the infinite banking process. Like that's all they did here. It's not like they worked any longer or got bonuses that they weren't expecting. This is just normal business. They just did what they were doing before, but they did it differently.
yeah. But no, I would say one thing that they did say, and I think you kind of mentioned that, Chris, their cash flow didn't really change.
Mhm.
Like that's what blew them away. It's like our cash flow is not really changing. It's just where is it going and how is it being utilized and who is in control of it. That's what changed, and it changed their entire life in a very, very short period of time.
That's an
Um,
awesome story.
But then the other thing I want to share is this is Amanda. And one of the things that a lot of us have done or want to get into is investing. And in most common way, a lot of people want to invest is through real estate because it is one of those tangible assets that we have to survive. And I've done a lot of real estate. Chris, you've done a lot more than I have. Banks are just kind of a part of that process. And a lot of people take that for granted. They say, oh, I got to go buy a home. I got to go get a 30-year mortgage. That's not the only way to buy a house. There's lots of ways to buy a house. We're just programmed to go do that. But what if you can be your own bank for things like real estate investing? And that's what Amanda wanted to do. So full-time investor, by the way, a fix and flip, and she had rental properties as well. Average deal size was about 80 to 150,000 per property. She obviously did not live where I live or where you live, Chris. Or yeah, she was in the South, somewhere in the South. So properties are a lot different. Long time student, by the way, of Chris Naugle's IBC real estate method. So this is where she kind of started learning about it. And so her challenge, though, she was doing about 3 to 4 flips per year, but always was facing a lot of challenges and stressed out every time she did a flip because she had to go get a hard money loan from a hard money lender, 10 or 12% plus 2 to 3 points. I've used those loans. They're nice because they're quick and fast, but it can be very sketchy because they're the ones in control. You've got to make payments sometimes. If your project does not go well, which I've had that happen before, you've got this huge loan sitting right there that has to be taken care of, and they're not going to wait for their money. So she wanted to close quickly. She was trying to use traditional banks because of the better rates, but every time she did that, it would take too long and she'd lose the project because somebody else would go and get the financing. And then, of course, the financing, the fees, all it would just eat up her profit. And then there was no way in her strategy to recycle the money back through her projects and her hands, which is something that obviously infinite banking can do. What we did is she wanted the capital, she wanted to have her own source of funding, and then she wanted a way to get her wealth building in addition to the rental properties. So her first policy, by the way, was it was 50,000 per year premium. That was her premium going in, but about 70% of that was going to the paid up additions. So we wanted this thing to have a lot of cash value. She also wanted to have a death benefit, though, by the way, because she had a family and she had kids, but no death benefit. And then she had all these projects that were in the middle of being renovated. If something happened to her, she started to realize all that debt and all those projects that were unfinished could come back on her family. All her rental properties that some of them had financing on them because she'd refinance them to get the money out and go to another project would come back on her family. And she's like, well, how do I take care of that death benefit? So she was initially looking at the policy as a way just to take care of the debt that she had existing on the rental property. And I was just like, well, how about we do all of this at the same time? So now she has a policy. The death benefit would take care of all of her existing debt if something happened to her prematurely. But she's also building the cash value so that she can start being her own bank. So after about 3 years, 115,000 available cash value. And so here's her deal execution now. So she can take a $100,000 loan. So that's how she does it. She'll fund a policy, she'll fund her project with her own policy. So as an example, this was one of her projects. She was giving me some rough numbers. Purchase price 80,000, renovation 20,000, closed in 10 days. No underwriting. That was her big thing right there. She realized that she was really getting, I'll just say it, pissed off about with all the underwriting and battling with the banks and the lenders. So now she doesn't do that. So there's no underwriting, no red tape. She basically pays cash for it. So imagine going to a seller with $100,000 of cash, no banks involved. Hey, will you sell me your house at a discount because I'm paying cash right now? I can buy it tomorrow, by the way. Holy cow. All of a sudden, she realized instead of trying to chase projects, she could choose which one she wanted because she had the power, she had the money. And so on that one project, I don't know if she hadn't sold it yet or something. She hadn't, I don't know if she'd bought it yet when I was talking to her. But 5 months later, she was projecting it at 165,000 purchase or sell price, and 50K a profit.
Yeah, you
And
should
then
check in with her and see if she's done that and actually have her kind of do a testimonial on that. That'd be
yeah,
really cool.
I'll have to go find her. But yeah, and so yeah, so she paid that loan back, with interest, of course, 105, but then she can just cycle it back again. And in fact, and I know that some of our colleagues do this, they don't pay their loans back, by the way. You might be thinking, well, Brian, if I'm the bank, aren't I supposed to be a responsible banker and pay my loans back? Yes, but why would she not pay her loan back? Because she's got somewhere to put that money right now. She's already got another project lined up. So with her, and now when we were going through the steps, she's like, wait a second. Why would I pay it back if I got a project in 3 days that I want to fund? I can just keep cycling the money back and forth, back and forth, back and forth. I'm like, yes, you can. Then if you have a period with no projects, pay back the policy loan. She's like, wow. So that's what she's planning on doing. But we also did the math on what she is saving by being her own bank as well. Because when it comes to real estate, there's a lot of costs, there's a lot of fees, and the more of those you can recapture, the more profit you have. So she was estimating 9,000 to 12,000 in hard money costs, closing costs, all that kind of stuff that was there that wouldn't be with her own banking system. And she also can keep 100% of the profits and stuff instead of paying it to somebody else. Dividends and compound and growth and all that kind of stuff is still working for her inside the policy. So she's her own private lending system. And then the last thing she realized, this was a cool one. I was like, well, wait a second. What if you don't want to do flips? She goes, well, what else would I do? Gee, Chris, what else could she do?
She could do rentals, couldn't she?
Well, she's doing that. She's like, what if I don't want to like be
Oh,
hands
she
on?
could, well, then she could be the bank truly and start doing lending to other people because she understands how to underwrite a deal. She's doing deals herself, so she could just be the lender.
So yeah, because I asked her this question. I remember this. Even though it's been a few years. I said, "Have you ever borrowed private funds?" She goes, "Yeah, all the time." And I sat there and I just watched her for a second. She's like, "Oh my gosh, I can be my own lender now. I can lend to other people." Yeah, I'm like, "Yes, you can." She goes, "Oh my gosh," and you just saw the light bulb moment go on in her head. She goes, "I can make money in more than one way now, multiple ways." I'm like, "Yes." So she does her own project or property. She's making money in her policy already. She's making money by paying herself back with interest. She's making money by not paying the hard money lenders all their fees. And I actually said, well, wait a second. You could pay yourself those same fees. Another light bulb moment went off. She started adding up all the ways you can start making money on one property and one project. And I was like, are you a licensed real estate agent? She goes, no. I said, are you paying them to sell your property and buy it? She goes, yes. Oh my gosh. If I'm an agent, I don't have to pay that either. She started realizing that, my gosh, she could up her profits by, it was like 25% on every project
Hmm.
by just changing a few things that she could do differently.
Wow, that's awesome. I like that one.
So
I mean, that's definitely right in my wheelhouse with the real estate investing. And I used to when I used infinite banking first, I used to pay off debt. But then after that, I started using it in real estate deals. And we were using it in our own flips, our own rentals, doing our own renovations, and not having to borrow money. And that was always the big thing. When we'd look at a flip that we did, probably a lot like Amanda here, you'd get to the end of it, you'd pencil out all the numbers for your profit, and you'd look at how much interest you spent on the money that you borrowed to get that deal to the finish line to be able to be sold. It was substantial. Most of the time, the private lenders were making the majority of the money. So whether or not she became the lender, or, in my case, where all we did is we just started funding our own renovations with our own money. And then at the
right.
end, when we'd sell the deal, we would just keep all the profits, right? So the profits didn't have to be split. In other words, you're not splitting it, but you're giving up a bunch of profit and interest. We were keeping all that. So I think she's starting to get that aha moment here.
Oh yeah. Well, and I shared a personal experience in real estate with her as well because I said, hey, now that you're starting to get the ball rolling, there's lots of ways you can make this work because you can start combining different ways of financing with your own financing. And I did a deal one time where there was a project. I could take it down. It was 400 some thousand to purchase it. No, 390. Different market, of course. And I had enough funds that we could get the property via hard money and then fund the renovations with our own capital. Right. But then another deal came up. And so when I was talking to her, I said, if when you have the money like this, you can always combine it with other financing. So in my case, instead of putting all of the capital we had into one project and one on the renovation costs, we got two hard money loans. I took our capital and split it into two properties. Fast forward, we did two properties instead of one, and our profit went from like 25,000 to I want to say 75,000. It's just
Big
math.
difference.
But I had the control. It wasn't like I was at the mercy of the hard money lenders because I had the capital. So I could do whatever I want. I could have done just one project, but I realized if I do this, I'm going to double more, almost triple my profit. So we ended up doing that. But first and foremost is we had the choice. So if you don't have the choice, it's done. You're done. You can't do anything different. So when I was working through with Amanda on her strategies, I was saying just remember you have choices now. The more choices you have, the more ways you can make profit, the more successful you're going to be. So I mean, she was very happy with with that strategy.
No, I love how we started with your ups and downs, your trials and tribulations, and then how you found your path, and then how you took that lesson that you learned yourself and then started passing this down to all these different, clients that you've helped do this.
Yeah, I mean, as an example, Chris, I just paid off 35,000 of debt here, I think last month, maybe. Yeah, something like that. That was business debt. So I closed a business that I just wasn't interested in, had some debt. I was like, okay, personal guarantee, you got to take care of it, hold it through policy. So, and now all I'm doing is I am now paying myself back. So the business revenue is not there anymore, but I had some assets, liquidated some of that stuff, and now I'm just paying myself back. So we
So
do
the loan you took out to pay off that bad debt you had, like how much did you used to pay on that loan?
on the debt,
Yeah.
about
Do you know, like how
1,200.
much is your monthly payment that you
It was
used
about
to give away?
about 12 to $1,500, right in
12
that
to
range.
1500. So now that you paid that off using your policy loans, you're
Yep.
now making the payments back to your policies
Correct. Yep. Yep. So it's just
dollar
my
for
cash
dollar.
flow really hasn't changed, to be
No, it's
honest.
the same cash flow.
Same cash flow. It's just I'm paying myself back. Now,
And when you
granted,
pay yourself back, that money's coming back to you and you're getting to use that money again for future things.
correct. Correct. So what I love about that is that we do exactly what we talk about. We walk the walk, we talk the talk. We do this stuff in our own lives. And we could show that to our clients as well. But yeah, that example right there, like I'm telling people, hey, this is how I'm doing it. I explain how we use policies, how I'm doing it myself, so that they can understand that, hey, when I tell you that this is the option or this is the way that we would build this policy and this is how we'd use it, it's coming from a place of experience. This is how I drive my car. I'm going to show you how I drive it, and you can drive the car the same way. Yeah, so that's the one way. And then the second thing that I want to do, Chris, and this is one that really got me excited on our last 3 day, is in the area of the country that I live in, within an hour radius of me, driving radius, there's a lot of mobile homes, a lot of mobile home parks. And in this area, there's a solid income job area market because there's a government and military. I want to get back into mobile home investments because they're a different way of investing in real estate because you don't have if they have axles, they're not a house.
Mhm.
They're not treated like a house. So you can buy them in with owner financing, very common, very common. You can do terms. I've done all this stuff before, and I'm really excited to get back into it. But this time it'll be very different than the last time I did it, because this time I am the bank. The last time I was not. I was using borrowed funds, scraping together savings. I was using credit cards, by the way, all that stuff to try to make a small deal work. And now it's just like, hey, you come in with cash, I write the rules.
Thou with the gold makes the rules.
Yep.
Brian, this has been awesome, man. You sharing your solving the money problem and also solving money problems for other people. Like, what is the one piece of advice you would give to anybody who's watching this?
One piece of advice. I mean, there's one that I always fall back on, but this is going to be two things. So the first thing is, if you want different results in your life, you've got to do something different. Take action, because knowledge is power, but knowledge with action is powerful, as I like to say. So if you guys are hearing this, and if you guys think that, hey, this could be something that could help me, my advice is take action. Whether that's keep learning, hop on a call with one of us, go get the Infinite Banking book on how to become your own banker. Just take action. Keep learning. Okay? That's my one piece of advice right there, because that is something in my own life that I have not done. And there's times where I'm like, hey, I scratched the surface, I saw the value, and then I chased the shiny object. I wish to the Lord that I'd come back and had focused on that thing and just take action on it.
I love it. Well, folks, I hope you've enjoyed this episode of Solving the Money Problem. Now it's time for you to make a decision. It's time for you to apply what you've learned. So if you want to learn more, right over here, this video, Secrets of the Wealthy, is the next video you should be watching. With that being said, thank you, and we'll see you on the next one.